The gentleman on the iPhone, can you hear us? The gentleman on the
standing still is going.
All right, who's that on the iPhone today? Can you hear us?
I don't know if you can hear us, but okay, well, let's we'll leave it on there for now. And okay, he's gone.
Okay.
All right, pretty cool. Oh no, he's coming back in. Let me admit him and then we'll get this going. All right, so welcome everyone. This is my name is Annabelle Pacheco. I host this call weekly with Paul Krause, and pretty much it's a multifamily space. It's a call where we really talk about multifamily, and we bring in guest speakers. You're free to share any current experiences that you're having in the multifamily space. And pretty much it's just a safe space for you to bring questions or to just learn and gain some more knowledge as far as the multifamily space is concerned. All right, I need the iPhone. Let me just mute.
Yeah, who's that on the iPhone today?
I just muted him. So anyway, just a little background on myself here, and then Paul can introduce himself. I have been in the real estate space for 25 plus years, started in the residential part of the business, and have been involved myself in multifamily commercial deals. And so I've pretty much spread myself out to that as an investor myself. And you know, there are clients that are always interested in growing their portfolio, and I've been able to share my experiences and just, you know, just me being in the trenches of what it actually takes to purchase multifamily. And it's just easier, right? It's easier to share once you've been through it. So this call is really for that. It's a call that, you know what, we invite those that are familiar with multifamily, are currently working in multifamily. You know, if you're looking and you want to share what you're doing, or if there's something that you need help with, or there's something that you're looking for, well, this is that space where you can pretty much jump on, share any kind of need that you have. And if we don't have an answer for you, we definitely have the resources that we can reach out to and get back to you. So again, we're not selling anything on this call. We're not offering anyone any kind of coaching. We're not financial advisors. We're just sharing our personal experiences, what we've done in the business, how it's worked for us, what we're doing, and just sharing it with you in hopes that you guys will go out there and do the same thing as well. So Paul Krause, welcome to the call. And, you know, if you don't mind sharing a little bit about yourself and what you're doing, and talk to us about multifamily today.
Yeah, active in the multifamily space, not geographically bound. So we're active still Chicago, Arizona, California, and definitely still finding deals, definitely still finding opportunities. You know, definitely using migration as one of the ways to find opportunity. In addition, anybody can use any of the online resources that might be available. I'm going to go ahead and share my screen if it's okay.
Yeah.
But basically been licensed since 2007 in California, licensed as a realtor and general contractor. So wanted to share this. This is from the Multi-Housing News website. I like sharing this this website because it tells you a little bit about what's going on. And I thought there was a very good article about some of the home buyer pessimism that's going on through some of the Gallup polls. And we hear about, you know, the market going through gyrations and changes because of interest rates, and how that's impacting the outlook. And what I thought was very interesting about this article here is that 3 out of 4 of the respondents in a recent poll said that they'll never have enough money to buy a home, and was it something like 29% are willing to even skip meals. So the outlook on where people feel that their future prosperity and things like that is an interesting thing to take a note of while we're going through some of these gyrations. Pricing's been soft in certain markets. It's still been hot in others. And I'm, for example, seeing some softness in the Midwest. I'm seeing it's still being hot in some of the Sunbelt states like Arizona. So depending upon where you're looking, we're finding a lot of different things in those markets. So it's important to really understand your market before getting invested. And like I said, I wanted to share this one, I thought, article that was kind of interesting. It's kind of implying that renters are willing to continue to rent, and that they're not as aggressively trying to buy a home, buy into that quote unquote American dream, like years and years ago. I don't know if you caught it, Annabelle, but Airbnb also said that their revenues for the first quarter of 2023 were higher. So there is still a lot of demand with respect to people who are traveling and with respect to people who are using non-traditional lodging means. So Airbnb is one of those providers that a lot of people have become very household names, so to speak. So there's a lot of opportunity still out there. I'm certainly still finding opportunity. So I thought this was a great article, though, because even though I'm seeing what I'm seeing as someone who's been in the marketplace a while, Gallup polls and other surveys are finding that their outlook is quite a bit different. And you almost have to wonder, is the average person getting access to, information that, is going to help them propel forward, or is it going to scare them off? Okay. So I wanted to share this great article. Definitely, we always want to know what is the outlook of potential buyers, potential sellers, potential renters. I'm going to put this in the chat right now.
So Paul, I think, just curious, if someone was starting to, they're looking to buy or get involved in multifamily in today's market.
Yes.
How should they determine a location? Like what would be, because obviously we encourage going out of state, right? We encourage, if you can't find any properties in your hometown, well then go out. How does one determine what area to go out to? At least, how can we help someone on the call that's maybe looking to get into multifamily, but they don't even know where to start? Like, where should they invest?
Yeah. So the very first thing they really need to think about is, where do they want to work? Where do you ultimately want to work? Because this is work. You and I both know that. And so one of the very first things is, what is accessible? What is a region or a neighborhood even? For some people, starting in a neighborhood is the most logical choice, because maybe they like a particular neighborhood. Maybe there's something about the neighborhood that it's aesthetically pleasing, or maybe it's easy to access. If you're deciding between what to choose between, let's just say, somewhere that you can drive to easily versus somewhere where you have to fly, are you okay with flying versus driving, or do you prefer driving over flying? I think you have to stick to some really basic questions before you get invested. What I was perfectly comfortable with was, if I can go to a location that I think has a great investment opportunity, and I can get there accessibly either by plane or by car, without too much difficulty or cost, then I was open to that possibility. I think what you have to do Annabelle, is we have to encourage people that, look at your personal situation. What is going to allow you to be able to really get to understand a neighborhood or a region, or let's just say a metro? What's going to help you to learn about that without too much difficulty with getting there and actually seeing it? Because I definitely feel that it's really, really important that everyone be able to either visit by car or by plane or a combination of both, relatively not, where it's not too difficult, where you actually enjoy visiting, you enjoy going there, you look forward to it.
Mm-hmm.
And at the same time, it allows you to be able to have enough free time after your field visits, because field visits is part of the deal, that you do your office time, which means that time to be able to map out and strategize what particular, whether it's multifamily, whether it's going to be college housing, whether it's going to be short-term housing, which we all, we think about Airbnb. In the world of multifamily, are you looking for elderly housing? Or are you looking for college housing? Are you looking for traditional market rate? Are you looking for, properties that you can develop, go ground up? So you're going to start with your personal situation and how easy it is for you to do your field work first before you decide a lot of other factors, because you do need to be able to go wherever it is you're doing work. Because like you and I both know, once you make that purchase and you own that piece of property, being able to visit it is super important to get a handle on what's actually happening with the property. It's okay to hire third-party management to handle the day-to-day operations, but ultimately as an investor, you're still responsible with what's happening with the property and what's going on in that particular neighborhood with the neighbors.
Well, and no one's going to do better than you will yourself, right? Even no matter who you hire.
Yeah.
And at the end of the day, it's our business, and we still have to be present.
Yes.
And we still have to be there. Yes, we can have people working for us and managing, but you can't just, you can't take your foot off the gas. You have to be there. And and I think, like, just from my experience, I think my decision to go to Texas was because, in my case, I had a mentor. I had someone that had already invested in that area, was doing well. And I thought, you know what, I'm not going to reinvent the wheel. I'm going there. And I liked it. I thought, Texas was nice. I was in Dallas and I was okay with it. And and everything that you said, we thought about, and we're like, okay, you know what, this works.
Yeah.
So I think that I think anyone that's looking to invest should really consider, asking yourself those questions, what Paul just said, because I think that will ultimately at least make it easier, right, to find that location or focus on that location that you think might be like worth spending more time and like just digging in to see, okay, do I really want to find a property in this particular area?
Yeah, and then the last thing, of course, is, are you excited about that area's prospects? So, for example, if you're someone who, let's just use Hollywood, California. If you are someone who really loves Hollywood and you really are excited about the prospects that neighborhood has, whether it be, people coming in and moving in, or whether you think, it's vice versa, the exact opposite. You think there's going to be lots of sellers and you think that all those sellers are going to translate into some kind of opportunity. You have to be excited about the prospects. I can tell you the reasons why I'm excited about certain prospects that I've gotten involved with, but ultimately they have to make sense for you, and they have to make sense not only to you from a conceptual perspective that, hey, I see lots of people moving here, I see lots of jobs opening up here, I see a lot of industries moving here, but in addition to that, the numbers then are your evidence to support what you believe are your prospects. So how do we gauge what that is? Well, we might look at pricing, we might look at rents, we might look at the yield, which means how much return we get out of putting, a a single dollar into an investment, how much we get back out of that dollar. Are we getting 50 cents back? Are we getting 25 cents back? Are we getting 3 cents back? So you really have to be excited.
Right. I agree.
Okay, so let's talk about what got people excited. And I brought up this chart today because what we're going to talk about is risk-free investing. And the reason why this is important is because risk-free investing is the alternative to doing what we do in multifamily. In other words, if someone doesn't want to make a family investment of some kind, what is their immediate alternative? Well, an immediate alternative is, well, what would be my return if I had zero risk? And if someone had zero risk, it's going to be absolutely with a treasury of some kind. And I put the 5-year up here. I could have even put the 2-year up here. But the reason why I think this is really important is because at the end of June, yields of 4.13% have basically made themselves available to the marketplace, such that if someone doesn't want to invest and take any risk with their money in any kind of investment, the risk-free rate is what is available to someone as an alternative, and treasuries are the risk-free rate. So what I did is I brought up a 54-year chart of what risk-free investing looks like. And let's just go through this really quickly because I think this is very pertinent to what we're talking about. So as you see here, during the 80s, this is when the Paul Volcker Federal Reserve was essentially trying to control inflation by raising interest rates. And that's when interest rates started hitting double-digit figures, 16% interest rates. What did that mean for us as consumers? Well, what that meant is if we wanted to earn 16% on our money, we could go out and buy a 5-year treasury and we could earn 16%. Well, we know how all that worked out and how all that played out over time. It absolutely, by raising rates, absolutely slowed down the economy. And we ended up back in a little bit more of an equilibrium. So what eventually occurred, which is what's a little bit more relative to today, and I'm going to talk about now the past 10 years, where this is a little bit more like the past 10 to 12 years. And the area that in particular I think is really critical to talk about is that area right inside here when COVID took place, because this is when interest rates were significantly low, historically speaking. There was a ton of activity. And what kind of ton of activity? Well, at any given time, 3-year, 4-year, 5-year, 7-year mortgages on multifamily loans were in the 3s and 4% range, and in some cases maybe 5. So what did that mean? Well, essentially what that means to us and how this impacts us is something like this. If someone is going out and getting a treasury for less than half of 1% or half percent on a treasury bond for 5 years, they're essentially earning, think of it like 5 cents on every dollar. Okay, like think of it that way. Like they're earning half a percent. I'm sorry, not even that much. I'm sorry, it's not even that much because 10 cents is actually considered 10%. So it's even half of that. So maybe think of it in terms of 1,000, right? So for every 1,000 that you have earning half of 1%, if 1% of 1,000 is essentially 100, you're only getting $50 back. So you're getting $50 back for every 1,000. Okay, fine. Well, if loans at that time were somewhere around 3% or 4%, that would put the loan somewhere right around here that you took out on your multifamily property. Okay, so what is the difference between that? Well, the difference is called your spread. And that difference between spread is how much the bank is basically earning to go out and make loans. And they make that on all the billions and trillions of dollars of loans that they're originating to people who are borrowing the money. And we're one of the people who are borrowing the money. So that was the risk-free rate. Now, let's back up a little historically again. And let's go back to, well, let's even go back to 1990. Okay. So what was happening really in the past 10 years is between today, where interest rates are, and even 10 years ago, we have somewhere where there's an average. And that average interest rate is basically, that is your risk-free rate. Okay, so again, what is risk-free? It means there's zero risk to losing your principal. Can you lose money in real estate? Well, yeah, there's a possibility of it, because depending upon where you bought and depending upon where you sell, you can actually realize a loss in value depending upon those 2 points in time. But with a treasury bond, if you hold it for its maturity, you will not lose money because it's backed by the full faith and credit of the US government. So you have an average. And Annabelle, like you and I both know, there is a complacency. People in investing, when they see that generally things stay the same for a while, they get complacent and they start getting used to things being a certain way. Well, for a long time in California, we had 2 to 3% cap rates, which means that, and if we just even go back, 5 years, that people were essentially getting on their real estate, on their multifamily real estate, the same amount on average as a treasury bond. Okay. So that was a sense of complacency. Well, in the Midwest, it was much different. In the Midwest, the cap rates were anywhere from 6.5% to 7% on high quality buildings, which would have been this level right here. And when I say on high quality, we're talking about strong neighborhoods, easily accessible to renters who generally pay on time, to properties that if a seller wanted to sell, there's relatively speaking at least enough buyers that can come in within a reasonable period of time, make an offer, and close on that property. So we call that kind of a liquid market. So that's where the Midwest kind of was. But California was way down here, and I would call it the Midwest was somewhere around here. And then on riskier investments, we were definitely in the 9s, and I would call this the higher risk category, because here you might be investing in tougher neighborhoods where the rental, renters being able to pay the rent, not consistent, or maybe high turnover and vacancy, not as easily able to rent these apartments, buildings that when sellers went to sell their buildings, not as many buyers, if any buyers, in a reasonable period of time, depending upon what the average is for that market. So riskier investments in multifamily investing would have been more around here, less risky investments right around here, and then the risk-free rate way down around here between 2 and 3%. Our investment marketplace got very complacent for the past 5, and I would even say longer, in some cases 7 years, that this is just kind of how things were. Okay, so that average all of a sudden spikes to here. So I'm going to now erase all this. And all of a sudden, that complacency goes away very quickly. And now you have interest rates that are 4 and 4.5% risk-free. Well, the thing that you probably noticed the most, I want to undraw that. There we go. We go back again. What we can see here is, what's the biggest difference? Well, the biggest difference is if we were down here at 2 and we could make an investment at a 6% cap rate, there was a spread between the risk-free rate, which is what you can just simply buy a treasury for, and what you could earn on a real estate investment in the form of its cap rate. And the cap rate is one of the measures we use to evaluate how much yield we get out of that investment. Well, now that we're up here, our spread is much different, right? So what's the very first thing that happens? Cap rates move higher in order to attract new buyers. So cap rates go higher, but in a reversal of fortune, prices go lower. Now, does that mean they go to zero? No, because assets have value no matter what. But let's just call it $1 million investment on a 10-unit apartment building, is it all of a sudden worth now $500,000 because interest rates have gone up? No, because at the end of the day, that cap rate is what drives the marketplace to make decisions about making certain investments. So the cap rate is always being measured against where this risk-free investment is in terms of yield, in terms of return. So right now, if someone wanted to buy one of my buildings and I say to them, well, I'm offering a 5% cap rate, which is only right here in terms of interest rate, in terms of how they think of how much return they're going to get on their investment, and someone can go out and buy a 4% treasury bond, how likely are they to take risk to only earn 1 more percent on every dollar they're investing to own something where there's risk versus something that's risk-free? Well, the answer is an investor's not really going to be willing to do that. They want to be compensated for that difference. So that difference is, well, Paul, I don't want to buy this building from you with a 5 or 6% cap rate, but if you can, maybe give me a little bit more return here for the risk I'm about to take, I'd be happy to buy it at 9%. Well, the problem is if pricing is an inverse relationship to cap rates, which means it moves the exact opposite direction, am I going to be willing to drop the price of that investment, that asset? And the answer is, it just depends. And it depends on what my motivation is. And right now, what we're seeing, like we've already talked about, Annabelle, is the fact that the buyer pool has really shrunk.
Mhm.
And what the buyer pool is very concerned about right now more than ever is history. And historically, are we going to end up, because the Fed just last week made an announcement they're going to raise rates again, are we going to see interest rates move higher to 7% or maybe 8%? And if so, what is that, and how does that affect the value or the price of those assets, which are the buildings we're buying? So the marketplace is concerned because now, instead of earning very small risk-free rates down at 0.5% to 1%, they're making anywhere around 4%. And when I was double checking just the 2-year treasury bond, right now, let me go ahead and erase this. As of June 30th, 4.87 on a 2-year treasury, which means if you hold that to maturity, you can realize a 4.87% on your money. If you and I can both earn 4.87, how likely are we to go buy an investment of any kind that has risk? Again, multifamily does carry with it some risk, to get the same amount of money. The answer is no, we're not willing to do that. Or if we are, it's only because we believe that this, for some reason, is going to be short-lived and is going to be heading right back down. That would be totally against what the Fed was just talking about, Annabelle, last week. So when the Fed announced that they're going to be potentially raising rates again, it caused some concern. And that speech took place right before the 4th of July, right before the parties, right before the celebrations, right before all the get-togethers, right? So this is what the marketplace is concerned about right now. And as investors, this chart right here should cause a little bit of concern in thinking about, okay, if you're buying something now at a particular price with a particular return, you want to think about it in terms of, well, how long, what is my goal here? How long do I want to own this investment for? If I want to own it for a really short-term period of time, is that a really good idea given, look at the spike in rates over a really short period of time from 2020 to 2023. That spike is straight up from 0.5% up to 4.25%. It's a huge move on risk-free investments. So this is what buyers are looking at, and it's what's causing them to pause and say, wait a minute, where can I find value? I don't need to bid with 10 other investors on this particular property. Now, are there some exceptions? Yes, some markets are still moving right along. Buyers are still in the marketplace, but on a national level, this spike in rates is causing the buyer pool to slow down and say, how much return are we really making? Because if we can go make 4.875 on a 2-year treasury bond, maybe we should just hold treasuries for the next 2 years and see what happens. Let me pause there.
Do you think that sellers will, obviously multifamily, owners that want to sell are going to have to negotiate. They're not going to be able to set a price and just be firm on that price.
Well, that's a great question. And the way I try to look at the answers to a lot of these, and I'm going to take us back to multifamily housing, and I'm going to bring us to the front page, because what I like to look at, Annabelle, is development.
Right.
What is being developed right now?
Mhm.
And let me go to the, let's just reject those. Okay. So what I like to look at is, well, what does development look like? Because if we can find that large institutions are acting in a particular way, whether it be bullish or bearish, bullish meaning that they believe that the prospects look good, bearish meaning the prospects look bad, I like to see, well, what are they doing? $24 million luxury community, construction scheduled to begin Q3. Okay, I might want to learn more about that.
Right.
Phillips International buying a Tampa area multi-housing
Manufactured.
Thank you. Yeah, 96 homes, by the way, right? Another firm, 62 new apartments, Utica, New York. Well, what's going on in Utica, New York? Is there a new employer there? During COVID, we saw a lot of different things taking place with migration, people moving out of California, people moving into Texas, people moving into Florida, people moving out of, say, New York. So all of these factors add up to, well, with all this confusion, what is the end result of all that? So this is what I'm starting to do, is I'm starting to look at, well, how are the institutions behaving? Because the institutions have all the money, right? They have all the money. So depending upon what the institutions and how they're behaving, that's going to give me an idea of, okay, if this is how they're behaving in my marketplace, now we're bringing it back around to your first question, how do we know where to invest? I want to bring this question back around to, how are they investing in my neck of the woods and in my neighborhood? And what's nice about this website, which is why I like sharing it, is we can look at different markets like the Northeast, Boston and New York, and we can look in West if I want to see especially what's going on in the Phoenix area. And I want to know, is there activity? Is that activity stagnant? Is it moving quickly? Is there development? Is there selling? Is there a mass exodus? Are there people breaking ground? Are there large acquisitions? $28 million, is that a big deal for this marketplace? Let's see what else. Are they developing land? Here's a $60 million refi in Phoenix. So why would someone choose to refi debt? Well, maybe they're getting out of old debt to get into new debt because there's a real incentive for them to do that because they're going to hold. Here's another group that's breaking ground near Phoenix. Here's Harris Street Toll Brothers sells a large Arizona student housing asset. Why did they sell? There might be an answer to that that kind of gives us some clues as far as what's happening in our marketplace right now. Here's a financing deal, another development deal, $1.8 billion.
Yeah.
I might want to know about those things because Arizona might be a part of the country that I want to be able to invest in. And, you mentioned Texas. Here's in the Southeast, if I want to learn something about Dallas or, Austin, then let's go. Let's see what's happening there. So here are some footprints where the big money, like an elephant, leaves a giant footprint. And that's evidence for us to gather to determine what is happening in our marketplace. So that's why I love multi-housing news. It's a great way to get a snapshot of what's happening, in addition to me being able to hop in my car, go visit, different properties, see what the vacancy is like, see how people are, their ability, their propensity to pay the rent. Are they getting behind? Are there no problems? Are there lots of problems? And then, after taking, some drive-throughs, talking to those local realtors and those local agents and those local lenders and asking them, what are they seeing in this marketplace? You were mentioning when you were getting involved in your Dallas deal that you had someone who was locally there to help you, and they were giving you information about that marketplace.
Right.
What's better than that?
Right. Well, and that's why I made the decision to invest. It made sense.
Yeah. Perfect. So that's a little bit what I wanted to talk about with respect to what is now driving our market right now. And it's really this chart ultimately at the end of the day. And investors are looking at this very, very closely, and they're saying, okay, we got complacent when on average our rates were somewhere around 2%, 3%, and our cap rates were somewhere around here between 6 and 8%. And these spreads gave us enough reason to take that risk. And that's kind of slowing down now.
Mm-hmm.
And for good reason. Where are we going to be? I don't know. And I don't think you would want to make a call on that any more than I would want to. So what we have to do at the end of the day is really we have to look at what is our goal. Number one is, what is the return on that investment going to be, assuming that, okay, we have found a neighborhood, we have found a building, we have talked to the local lenders, we've talked to the local brokers. What does that look like by percentage compared to, say, just buying something that's risk-free? Second, what is that? What does that turnover look like? I'm going to just call this turns. Turns is when you have a tenant that comes and goes. And how quickly are they going? Are they leaving between 1 and 13 months? Are they leaving between 13 and 24 months? Like, what does that turnover look like? And then on leasing, another really important part. What does leasing look like? If you were to put an ad in your, let's just say apartments.com or maybe some kind of local listing on the MLS, how long does it take from the time that you advertise that property? What does that time look like till the time that actually someone signs? And they sign that lease. Is it 5 days, 10 days, 3 days? Is it in an afternoon? Remember, Annabelle, not too long ago, back in 2018-19, you could put a lease listing on the MLS on a single family house in just about anywhere in Southern California, and you could lease it in the afternoon.
Yep.
You could put the listing out in the morning and you had it rented by the afternoon. That's how quickly. And that's not happening anymore.
Right.
In some places I live right now, it's taking 130 days.
To lease.
So it's a big change.
Days on market, 130 days.
Days on market, 130 days.
Wow. Incredible.
Yep.
So let's stop for a second.
Yeah.
Paul and Bonnie, I know you're on this call. Any questions so far? Because it's definitely been a lot of information thrown out there. So any questions?
I don't have any questions.
Okay, fantastic. Are you currently looking to get involved in multifamily?
I am looking in general. I'm in San Diego, so the
Great.
market here it's not an easy entry point. So I have been looking, and I appreciate what you'd said about, purchasing property away from where you live. That's why I haven't done it, because I want to stay here.
Right.
So I'm trying to make it work somehow. I'm I'd like some kind of passive income at retirement, which is coming up sooner than I'd like.
Mhm.
Anywhere in California would be great,
Okay.
but
you-
preferably,
Have you
Yeah, where-
considered maybe partnering up with someone?
absolutely. Yeah, a multi-member LLC is what I'm actually involved with. The several people were having conversations about doing that together.
So are you guys putting together a group? And then going out, or are you guys all coming together with your own money, or someone gonna handle the money, like just syndicate and get other investors to put money in, or kind of what are the talks so far?
It could be a combination of both, because I know people who are actually interested in living on site, and I know a silent investor, and then yeah, it's a mixture. Everyone has different goals.
Okay,
Of course, yeah. And it sounds like what you're looking to do is be like a silent partner where you join the group by contributing a certain amount of capital. You put your capital with their capital together, and it sounds like if you have some people living there, that your goal is that you would have someone locally
Okay.
who's essentially looking after the property, and your guys' capital eventually comes back to you in some form of waterfall stream, whether it be over 3 years, 5 years, 7 years, something like that. Is that kind of a fair description of what you're getting involved with now?
Maybe if I do it with the self-directed retirement account, but I'd also have an option of living there myself. So purchasing the property with several friends, and that's just where it's like a co-housing type
Mhm,
of situation that's popular more in Europe than it is here,
mhm.
but that's also an option.
Yeah.
Which would make sense. I mean, I know the prices in San Diego are they're not cheap.
They're not cheap. Yeah.
So, yeah, so I mean, if you guys are talking, I mean, I don't know, like, let's say, what, 10 doors? 10 doors will probably run you, I mean,
I'm thinking 500 a door
easy.
in
I mean,
San Diego.
yeah.
If it's up.
Have you
I
looked at
look-
anything?
I looked at one just a couple hours ago. I think it was 1.8 for 5 units.
Okay, so one
So that's
point,
almost 400. Yeah.
yeah, so, yeah, 1.8.
Is that a nice part of San Diego, Bonnie? Would you call that like an A rating, which means absolutely choice prime on the water, or would it be more like a B, where it's a little bit older of a building, away from the water, but still in a relatively high demand place? Or is that a C, which is more like, okay, not as high demand, not as high rents, but still you can rent the building, not a problem. Much older building. Well, how would you describe between A, B, and C?
I wish I could say. I just know based on neighborhood. So this particular neighborhood was like a middle class, blue collar neighborhood, but anywhere in San Diego, rents are really high because we are having a housing crisis.
Mhm.
So
Okay.
high demand.
Okay.
So-
So if it's not right on the water, maybe it's a B.
Probably a B.
Yeah. But 400 a door though, that's a big nut to crack. That's
450 a door.
yeah. Yeah.
Wow.
Yeah, that's a lot.
Yeah.
So sometimes, I mean, that's when, sometimes you really have to do the numbers, right? And if you guys, we said 4 doors, did we say 4 units?
5 for that
5
one.
units. Okay, we said 5 units. I mean, you have to make sure that the income that you are generating from those other doors will cover your mortgage
Yeah.
and your expenses. And is there money left over?
Right. That's why San Diego, I've been stuck because to stay here, it doesn't really make sense. I attended a multifamily investor conference several years ago, and it
Mhm.
didn't make sense then either. And they just actually promoted and marketed to this area because there's money, not because the properties are actually in, a good investment. So
Right.
I'm open to outside of this area. Um,
And you're
I
looking
just,
to invest, I'm sorry to interrupt. You're looking to invest passively, right? You're not looking to be like boots on the ground. You want to do work, or do you?
I don't have, I'm not clear on that because I did learn about the, bonus depreciation option if you're actively managing for 750 hours a year type of thing. So that seemed interesting. And it just kind of depends on how all the people come together.
Yeah.
Okay. Okay.
So, what's kind of interesting about that deal is, at 1.85 million, right? So you're essentially, if you do a traditional 70-30, where you're going to put 30% down, 70% gets financed at a 6.5% interest rate, you're looking at 81, 85, so call it $8,200 a month nut. So you've got to basically collect that $8,200 amongst 4 doors. So that $8,200 divided by five, sorry, it's five. It's about $1,640 a month minimum before you've even paid for your property insurance, your taxes. You want to put a maintenance reserve, which means, if things break down and things like that, that you've got a reserve to pull from. So you've got a very interesting deal that you're looking at. And I agree with exactly what Annabelle was saying, is that something like this, where you're buying at a large price per door, knowing what your entry and your exit strategy is going to be ahead of time is going to absolutely be really, really important for you and your investors. Should you decide to move forward with that, that's a really big investment. Does everyone, who's going to be involved, does everyone see the investment the same way? Do they all agree that, hey, 3 years, 5 years, 7 years, whatever that may even look like,
Right.
20 years down the road, is that the holding period that everyone wants to tie up their money? So these are all really good things that you're getting exposed to. And by all means, I'm going to put my contact in the chat. Annabelle is also going to do the same. If we can be of any service assistance to you in any way, we've put lots of deals together. By all means, you can always email one of us and hey, does this sound right? If nothing more, because we do a lot of these, and what you're getting exposed to right now, we do every day, and it's good to bounce these ideas off people that have done deals,
Yeah.
not only just in California, but maybe they've done lots of deals, and then maybe they've done them outside of California, in Arizona, or maybe Dallas, or maybe New York, or maybe San Francisco, and they bring a perspective and learning that you can gain from as well. So we're happy to help in any way we can. I'm going to put my contact in for you.
Yeah, I put my contact there as well. There are other areas here if you want to stay in California. There are other areas, Bonnie, that you can look at, and maybe that's a little bit east, where prices might be, it'll make a little more financial sense. If you're interested, I definitely, either Paul or I can help you. I do have access to commercial, it's called CoStar. So I have access to the kind of quote unquote MLS for multifamily. And I can send over some properties, if anything.
Okay, so you're basically a real estate agent specializing in multifamily properties.
Correct.
Is that correct?
We both are. Yeah, exactly.
Yeah, we both have, we work with sellers, we work with buyers, we've done residential, and we're currently invested in multifamily, and that's why we can offer the multifamily, at least advice, because we're both kind of in the trenches doing that now and involved in it.
Okay, because if the numbers were correct that you shared with me, sorry, I didn't get your, besides Annabelle, who else is on the call?
Paul.
Okay, Pete, okay. So it would actually be on a good day, $1,600 a month cash flow for something like that.
Yeah.
Not-
I
So
mean,
you'll
and
be negative.
you'll be-
Yeah, so you'll run a negative at a 70-30 loan at today's interest rates. So
Okay.
that's why it's good we're talking about it.
Yeah.
Yeah. That's great. But, it's not that it's an unworkable deal. It's just that, maybe the building needs to be repurposed in a way that's going to get a much higher cash flow. You never know. There's lots of different strategies to enhance cash flow. And, sometimes you might have to do a hybrid approach to the marketplace where you say, well, part of it's going to be short-term rental and part of it's going to be long-term rental. And, maybe the floor plan or the layout of the building lends itself to a repurpose that would allow you to enhance that cash flow. So that's why it's good to look at the total deal and really, run it by lots of people because you never know. Running it by a lender, running it by, between Annabelle and myself, just in the past 2 years, probably done more than 14 or 15 multifamily deals just in the past 2 years. In the trenches, we see this every day. And, you may have a great property, but just sometimes it might just be a matter of repurposing the deal
I think that's what I was gonna add that, Paul. Like,
yeah.
there's value add opportunities in properties, Bonnie, that once we look at them and we're looking at the area and we see what other units are going for or how their conditions are or what they're offering, what they're doing. I mean, you've got to do your homework. Then you're able to really come back and say, hey, maybe 1.8 is a great deal, right? Because there's opportunity here to improve on that property, on those units, and the rent can be even more. Or maybe we come back and after analyzing and looking at stuff, hey, it doesn't make sense. There's just no room to make any money. So
Yeah,
I think as part of our service, we definitely, we can talk. I mean, if you want to put your info on the chat, I can call you after, I can call you after the call. We can talk in private and see how both Paul and I can help you.
okay, I will. I'm particularly interested in the new laws in California that allow for subdividing the property and creating up to four units when there was really only one, like 2 duplexes essentially.
Mm-hmm.
So cliff note alert on that is just know that even though the state of California legislature passed that law that allows for what you just described, some cities have not been very receptive, although they're bound by the rule of law. Some cities have not been very receptive to being able to do that because the local laws to a particular township, city, may or may not allow for subdividing because they have green requirements. So just be aware that investors like ourselves and like yourself, you're going to run up to certain cities that may or may not be conducive to that plan. So you always have to check with your local city.
Yeah, we have 19 different municipalities here in this county. They're all different. So
Yeah, I got it.
And let me tell you, and you'll have to check, like wherever you see the property, you're gonna have to go to that municipality and you need to find out from them because they'll all be different.
yeah.
And also, the zoning of that particular property. I mean, I have in my same municipality, I could purchase a single family residence that sits on, maybe 50,000 square feet over an acre. And I can definitely go in there and split that lot and create another property. Then you can go into another property that's 100,000 square feet or lot size, and you can't split the property.
Yeah.
So it is very important to to speak with the municipality for that particular home. So these are things that we can definitely talk some more, and I'll take down your info and I'll give you a call back, and we can definitely talk some more about this and see how Paul and I can help.
Okay, in the meantime, thank you for the information. I'm here
My-
just trying to learn.
My pleasure.
Thanks for
Thank-
joining us.
Yeah, thank you for joining us. This is a call that we host again every Wednesday. It's at 2 p.m. We do bring in guest speakers, so we'll have just whenever we can get them to come on the call, we'll have them join us, and we'll have lenders, we have other investors, multifamily property owners. I mean, we bring what we can to the call so that we can all learn. But thank you, Bonnie, for joining our call. Paul, thank you for doing a great job of sharing
Welcome. Thanks, Annabelle.
info.
Appreciate
And,
you.
we will see you guys next week. Take care.
Sounds good. Thank
All
you.
right.
See you all.
Thank you both.